We are standing at a precipice. Forget everything you have been told about retirement planning, about the sacred 60-40 portfolio, about balanced funds, and about the long-term historical stability of the major indexes. That paradigm, the one that saw 30 years of decreasing interest rates and contained inflation, is dead. It has been fundamentally shattered by an economic experiment of historic proportions, and for anyone who is retired or approaching retirement, the next 5 years will not merely be challenging. They will be existential unless you radically reposition your entire capital structure. I have spent decades navigating the deepest waters of the commodity and financial markets, observing cycles of human greed and government desperation. What I am seeing now is not a cycle, it is a structural failure. It is the final collapse of trust in the world's reserve currency system, exacerbated by central banks that have painted themselves into a corner from which there is no peaceful inflationary exit. And if you are relying on fixed income, on bank deposits insured up to a limited arbitrary amount, or on dividend stocks whose profitability is contingent on perpetual cheap debt, then you are relying on promises that will, in the not-too-distant future, be broken. The traditional advice for retirement, the notion that you just need diversification across various paper assets, is fundamentally flawed in this environment because it fails the primary test of wealth preservation, the mitigation of counterparty risk. What is counterparty risk? It is the danger that the entity holding your asset, the bank, the bond issuer, the brokerage house, fails to fulfill its obligation to you. When the entire financial system is leveraged beyond comprehension, when sovereign debt levels in the Western world exceed any reasonable metric of repayment capacity, then the system itself becomes the ultimate counterparty risk. My contention, which I have argued for years, is simple. Preservation of capital requires tangible assets that exist outside the electronic ledger and outside the sphere of immediate government control or banking manipulation. We are past the point of sophisticated paper shuffling. We must return to immutable value. For those in retirement whose window for recovering losses is severely limited, the focus must shift entirely from capital growth to capital defense. And in this perilous defense, I firmly believe that you only need 3 distinct classes of assets to ensure your financial survival and the maintenance of your purchasing power over the next decade. Only 3. Why such a radical simplification? Because complexity breeds confusion, and in times of crisis, confusion leads to delayed action and fatal errors. We need clarity, solidity, and most importantly, assets that cannot be printed into oblivion by desperate politicians or central bankers. Let's first establish the sheer scale of the conflict facing the retired investor today. It is universally accepted that the #1 enemy of retirement is inflation. But we are not talking about the controlled 2% inflation the governments report. That number is a statistical lie, specifically designed to understate the actual destruction of the purchasing power of your savings. If you are tracking the costs of energy, housing, and healthcare, the 3 essential costs for a retiree, you know the true rate of inflation is multiples higher than the official consumer price index. When inflation is running at, say, 8%, and your savings account or certificates of deposit are yielding 1 or 2%, you are guaranteed a negative real rate of return of 6 to 7% annually. This is not static loss, it is corrosive. It means that every year you keep your capital in those so-called safe accounts, the state is effectively confiscating 6 or 7% of your life savings. This is financial death by 1,000 cuts, particularly for those on fixed incomes who cannot wait for a market recovery. Your time horizon for wealth recovery has evaporated. Now consider the bond market. For decades, long-term government and corporate bonds were the bedrock of retirement security. They were the safe haven, the stabilizing force in the 60-40 model. Today they are perhaps the most toxic asset class available. When interest rates are suppressed by central bank intervention, quantitative easing, and inflation rages uncontrollably, bonds become guaranteed losers. Why? Because the nominal yield they pay cannot even come close to covering the rate of monetary debasement. Furthermore, the immense amount of debt piled up by sovereign nations ensures that the only way for governments to handle their debt burden is to inflate the currency away, a process that destroys bondholder value. Holding a 10-year Treasury bond today is effectively a vote of confidence in the government's ability to repay you in dollars that will be worth significantly less in the future. It is a loan guaranteed to lose money in real terms. If fixed income is toxic, what about equities? Many believe dividend-paying stocks in large established companies offer protection. They offer revenue streams and perceived stability. This is partially true, but a large swathe of the mainstream equity market, especially the index heavyweights, are highly leveraged and dependent on the continuation of cheap money. When the central banks inevitably lose control of the long end of the yield curve or are forced to truly tighten liquidity to save the currency's integrity, these leveraged companies will face a massive liquidity squeeze. Their debt servicing costs will skyrocket, wiping out profitability and dividend capacity. The safety found in broad market indices is illusory when those indices are dominated by companies that are structurally fragile in a high interest rate, high inflation environment. The conflict, therefore, is this. The assets traditionally recommended for retirement, cash, bonds, and mainstream equity, are precisely the assets most vulnerable to the current economic reality of systemic debt and monetary debasement. You are being asked to store your wealth in instruments that represent someone else's promise to pay, in a world where those promises are rapidly becoming non-viable. So the open loop remains. If every traditional sanctuary for capital preservation is compromised by counterparty risk, inflation, and systemic leverage, where does one turn? The answer requires a profound psychological shift, from assets based on credit to assets based on substance. We must look toward the small, non-financial sector of the market, those tangible assets that have historically functioned as money and maintained purchasing power across thousands of years and countless failed empires. We need assets that, crucially, cannot be conjured into existence by a politician's signature or a keystroke at the Federal Reserve. This development phase demands we understand the unique historical context of this impending monetary transfer. When confidence is lost in paper money, wealth does not simply vanish. It rapidly shifts, transferring from the holders of vulnerable fiat assets to the holders of immutable, physical assets. This is the great transfer of wealth. This shift is characterized by speed and non-negotiability. Those who wait for the official confirmation of collapse, those who wait until the dollar index is truly unstable, will find that the physical assets they seek are already priced out of reach or simply unavailable. Consider the history of monetary collapse. Whether it was the Roman denarius, the German papier mark, or the Zimbabwean dollar, the playbook is always the same. Governments spend more than they take in, they resort to debasement, and eventually, the population realizes the currency is rapidly losing its function as a store of value. The instant that realization becomes widespread, people flee paper for anything real: land, commodities, durable goods, and most importantly, the historical metallic standard. This is why diversification in paper assets today is not a hedge. It is merely diversifying your exposure to systemic failure. Having 10 different types of worthless promises is still having worthless promises. What the retired investor needs is a fortress, a highly concentrated portfolio designed solely for survival and the preservation of purchasing power against the ravages of monetary mismanagement. This brings us back to the required simplicity and clarity. The three assets I advocate for, and these are not speculative plays, but core capital preservation tools, must possess three specific characteristics. 1. Immutability. They must be tangible and possess intrinsic value recognized globally, independent of any government decree. 2. Scarcity. Their supply must be finite and resistant to rapid inflation via mining or technological means. 3. Low counterparty risk. Ownership must be direct, not custodial. If the bank fails or the broker goes bankrupt, the asset must still belong unequivocally to the investor. Now, let's re-engage the core audience. If you are retired, every year you delay this repositioning, you are accepting a guaranteed destruction of a significant percentage of your wealth. Time is no longer on your side. We are not talking about getting rich. We are talking about ensuring that the money you worked your entire life to accumulate can still purchase the necessities of life 10 years from now. This is a defensive strategy of the highest order. This is why, After years of studying the impending collapse of the fiat structure, I have concluded that the focus must be laser-sharp. We must eliminate complexity and focus exclusively on the assets that have proven their worth when everything else failed. I am not suggesting a broad basket of commodities which carry high storage costs and volatility. I am not suggesting physical property, which is subject to confiscatory taxation and lack of liquidity. I am focusing on the ultimate defenses, the assets that are the historical anchors of wealth. The ultimate defense for the retired investor rests upon these three categories. The first asset category must be the ultimate store of value, the central banker's choice for thousands of years, the asset that has survived every war, every plague, and every monetary regime change. I am, of course, referring to physical gold, not paper gold, not ETFs based on unallocated futures contracts, but actual, tangible, verified physical metal held either in your direct control or in highly secure, non-bank, non-jurisdictional private storage. Gold is the ultimate anti-fiat currency. Its supply is fixed, its demand is universal, and its cost of production ensures it cannot be easily inflated. In a high inflation environment coupled with geopolitical instability, which is precisely where we are, gold does not just keep pace with inflation. It typically outperforms dramatically because it is the designated flight-to-safety asset when sovereign promises collapse. Its purpose in your retirement portfolio is purely defensive. It is insurance against complete systemic failure. If the central banks lose control of the bond market or are forced into a sudden massive currency reset, gold is the parachute. It hedges the risk of the dollar going to zero. If gold is the defensive anchor, the second asset must provide a leveraged component to the inevitable industrial and monetary demand resulting from the failure of fiat. This metal carries significantly higher volatility, but also significantly higher upside potential when the precious metals cycle turns fully positive, which occurs during periods of sustained monetary debasement and real commodity shortages. This asset is physical silver. Silver historically has a dual nature. It is money, just like gold, but it is also an essential industrial commodity used in rapidly expanding sectors like solar power, electronics, and medicine. Its above-ground supply relative to gold is much smaller, and its use in industrial applications means that massive quantities are consumed annually and often impossible to recycle economically. The ratio between gold and silver remains wildly skewed in favor of silver's potential appreciation. For the retired investor, a specific manageable allocation to physical silver, again, direct ownership, provides exposure to the leveraged upside when global industrial demand meets collapsing faith in paper currencies. It is the offensive complement to gold's defense. While the first two assets focus on direct physical preservation, wealth creation and the ability to fight inflation require a component that generates operational cash flow and provides maximum leverage to the rising prices of the physical commodities themselves without the risk of storing vast amounts of physical metal. This third crucial asset class is high-quality, low-debt precious metals producers, miners. These are not speculative junior exploration companies, but established, well-managed mining companies that own physical reserves of gold and silver in stable jurisdictions. Their costs are relatively fixed, meaning that when the price of gold or silver rises substantially, say from $2,000 to $4,000, the miners' profits do not merely double, they multiply exponentially due to operating leverage. They become wealth machines, providing the potential for capital gains and, in the case of senior producers, increasing dividend yields, which is essential for funding a retirement lifestyle that is increasingly expensive due to inflation. This component is the engine for growth and the provider of liquidity. These are the three legs of the retirement preservation stool: physical gold for systemic insurance, physical silver for monetary leverage, and high-quality producers for operational leverage and liquidity. The conclusion is inescapable. The time for balanced portfolios that rely on central bank competence and government solvency is over. Retirement security today hinges entirely on the ownership of assets that carry zero counterparty risk and have a proven, thousands-year history of retaining purchasing power against hyperinflationary policy. These three assets provide that required protection. They are simple, tangible, and highly effective. We have only just begun to outline this defensive structure. While I have revealed the what, the critical question for the retiree is the how. How does one correctly allocate to these three categories? What are the specific red flags when purchasing physical metal? How do you vet a safe, non-bank storage solution? And crucially, how do you distinguish a high-quality mining company from a speculative disaster waiting to happen? Stay with me as we delve into the practical mechanics of assembling this ultimate retirement defense. In the next part, we will dismantle the common myths surrounding these assets and provide a detailed, actionable blueprint for implementation, ensuring that your capital remains secure against the turbulent monetary future that Eric Sprott and many others foresee. I have spent decades watching market cycles turn, studying the failures of monetary policy, and analyzing the psychological inertia that keeps good people invested in bad ideas. If you're retired or nearing retirement, the one thing you cannot afford is inertia. The illusion of safety, often peddled by traditional financial advisors, is the greatest threat to your long-term solvency. We've established the fundamental premise: central banks are trapped. The debt burden, the colossal unsustainable debt mountain, demands perpetual currency debasement. They cannot hike rates without collapsing the system, and they cannot stop printing without defaulting on their obligations. Therefore, the only viable path for them is to inflate away the value of the currency, slowly grinding down your purchasing power until your savings are nothing more than fiat confetti. This is not a conspiracy theory. This is arithmetic. It is the inescapable reality that makes the conventional 60/40 portfolio a historical artifact, a relic of a time when governments were solvent and interest rates reflected reality, not intervention. If you are holding significant allocations in treasury bonds, corporate bonds, or even cash accounts that yield less than the true inflation rate, which is substantially higher than the official numbers, you are actively participating in the quiet, systematic liquidation of your future. You are mistaking liquidity for safety. You can sell your bond instantly, yes, but what is the buying power of the currency you receive? That is the question that matters. That is the crisis we must address head-on. My analysis, based on a lifetime immersed in capital markets, consistently points to the same inescapable conclusion. True safety, the kind that survives systemic hemorrhage and monetary collapse, resides only outside the counterparty risk inherent in the banking and governmental systems. True safety is physical. It is tangible. It requires no promises, no government guarantees, and no faith in politicians who are incentivized to perpetually kick the can down the road. We are looking for assets that not only preserve wealth but are designed fundamentally to thrive when confidence in paper money evaporates. We are looking for the financial anchors that hold firm when the global ocean of debt unleashes a tsunami of inflation. This brings us to the core of the strategy. If you are retired, seeking preservation, stability, and a reliable hedge against the coming storm, you require only three specific classes of assets. Two are the foundation, the monetary bedrock. The third is the mechanism for growth, the engine that maximizes your returns without exposing you to undue operational risks. Let's not waste time. The first asset is the historical standard, the only true monetary asset recognized globally for thousands of years: physical gold. I stress the word physical. Do not be fooled by paper derivatives, unallocated accounts, or exchange-traded funds that claim to hold gold, but are often part of the fractional reserve game played in the bullion banks. When the real panic hits, and the paper-to-physical ratio, which is already astronomically high, snaps back toward reality, you do not want to be holding a paper promise demanding delivery of something that simply isn't there. Gold is essential because it is a non-counterparty asset. It cannot be printed into existence by a desperate treasury secretary, and its value is intrinsic. It is finite, portable, and globally accepted. In a retirement portfolio, its role is singular: ultimate wealth preservation. It is the lifeboat. Its price may fluctuate in fiat terms, but its purchasing power, historically, remains remarkably stable over time, especially during periods of high monetary debasement. Think of it as insurance against policy stupidity. The critical metric to watch for gold isn't its daily price, but the dwindling supply of minable ounces juxtaposed against the inexorable expansion of the money supply, M2. The gap between those two lines is your profit margin. As money supply accelerates geometrically and gold production remains stubbornly linear, the price must adjust upward to reflect the true scarcity relative to the available currency. This adjustment is necessary, inevitable, and potentially explosive. Your allocation to physical gold, stored securely and perhaps vaulted outside the primary banking system, should form the largest foundational element of your precious metals exposure. Now we move immediately to the second essential pillar, which offers the leverage and the industrial necessity that gold often lacks: physical silver. Silver is often called the poor man's gold, but that moniker significantly undersells its role. While gold is purely a monetary metal, silver is dual-natured. It is both an ancient store of value and an indispensable industrial component. It is consumed in rapidly expanding technologies: solar panels, electronics, electric vehicles. Unlike gold, which is largely recycled or stored, a significant portion of mined silver is used up and scattered into the waste stream, making its future recovery economically unviable. This creates a critical scarcity loop. For the investor, silver provides superior volatility and leverage compared to gold. Historically, when gold rallies significantly, silver rallies harder and faster. If we are entering a true monetary crisis, and all signs indicate we are, the gold-silver ratio, the number of ounces of silver required to buy 1 ounce of gold, should compress significantly from its current historical highs. This compression is where the exceptional leverage resides. Furthermore, the above-ground physical inventory of investment-grade silver is shockingly low. The COMEX paper market manipulates the price on a daily basis, but the physical reality is that industrial demand, particularly from China and India, is relentless. When the investing public finally realizes the depth of the monetary instability, the rush for physical silver will drain the remaining inventories extremely quickly. For a retired individual, a substantial allocation to physical silver bullion acts as a high-octane growth accelerator for your wealth preservation base. It is the tactical asset, ensuring that you capture the massive upside potential inherent in a commodity essential to modern society, but priced as a monetary afterthought. Now, it is imperative to address the gap. Holding physical bullion is necessary for safety, for ensuring zero counterparty risk. But pure bullion holdings are static. They preserve wealth, but they do not dynamically grow capital at the rate necessary to outpace the rampant inflation that is currently being unleashed globally. To truly maximize the opportunity, particularly in a retired portfolio where avoiding operational risk is paramount, we must turn to the final and perhaps most sophisticated component. This is where decades of specialized knowledge in resource finance prove their worth. You need exposure not just to the metal itself, but to the engine room that brings the metal to the surface, but without the messy, costly, and inherently risky elements of mining operations. The third asset class, and this is the key to maximizing returns while minimizing typical equity risks, is select precious metals, royalty, and streaming companies. Let me explain exactly why this asset structure is essential, particularly for the retiree who cannot afford high volatility operational risk. Traditional mining is a brutal business. Miners face astronomical capital expenditures, CapEx, labor strikes, unforeseen geological issues, regulatory delays, geopolitical risks, and soaring energy costs. If the price of gold drops, their profit margin evaporates quickly because their operational costs, OPEX, are high and fixed. This is true operational risk, and it is toxic to a preservation-focused portfolio. Royalty and streaming companies operate on a fundamentally superior, de-risked business model. They are financiers. They provide upfront capital to the miners to build or expand their mines. In return, they receive either a royalty, a percentage of the revenue from the metal produced, or a stream, the right to purchase a percentage of the future production at a fixed, extremely low cost. Think about the advantages. These companies require minimal staff and minimal infrastructure. They incur almost zero operational expense or capital expenditure. They don't dig the holes. They simply collect the proceeds. When the price of gold or silver rises, the revenue of the royalty company increases immediately, but its costs, which were fixed years ago when the deal was signed, do not. This creates extreme, nonlinear leverage to the underlying metal price. It is arguably the cleanest and most efficient way to gain equity exposure to precious metals without inheriting the operational liabilities of a traditional mining company. For the retired investor, this model is a sanctuary. It provides diversification across dozens or even hundreds of projects globally, mitigating single mine political or geological risk. If one mine fails, 50 others keep paying. Furthermore, they are often paid from the first ounce cars produced, meaning they get paid back before the operating miner sees a penny of profit. This senior position in the capital structure is crucial. The beauty of the royalty structure is that it often turns marginal projects into viable assets when metal prices rise. The costs remain low, fixed, and predictable, while the revenue flows are direct and immediate. These are high-margin, debt-averse businesses that generate immense free cash flow, which often translates directly into dividends, providing that crucial stream of income necessary for retirement living. Consider the interplay of these three assets: gold, silver, and royalties. Gold provides the ultimate, unleveraged ballast, your core insurance against systemic failure. It ensures that when fiat currency collapses, your wealth remains intact. Silver provides the aggressive leverage. It offers the potential for disproportionate gains, riding the massive wave created by simultaneous monetary and industrial demand shocks. The royalty companies act as your equity engine. They take the inherent stability of the metal price movement and magnify it through their superior economic model, transforming modest price appreciation into substantial equity returns and income generation. They are the investment vehicle that allows you to participate in the mining profits without signing up for the mining headaches. They are the essential growth component necessary to ensure your purchasing power increases, rather than merely holding steady during an inflationary supercycle. This is the entire philosophy compressed into three definitive assets. You do not need a complicated, sprawling portfolio managed by high-fee institutions that are mandated to keep you invested in the system they are desperate to save. You need simplicity, tangibility, and a clear mathematical leverage to the only reliable store of value. The shift is underway. Institutional investors, seeing the writing on the wall regarding sovereign debt and geopolitical instability, are quietly accelerating their own physical holdings. They understand that the era of endlessly declining interest rates is over, and the era of real asset repricing has begun. The window of opportunity to acquire these assets at prices still depressed by the paper market is finite. Once the retail public realizes that the inflation they are experiencing is not transitory, but rather structural and permanent, the demand for physical precious metals will overwhelm the available supply instantaneously. My advice to anyone in or nearing retirement is definitive. Review your portfolio immediately. If your primary allocation is still in bonds, conventional equities, or high-risk technology stocks, you are playing a game of musical chairs right when the music is about to stop. You need to transition that exposure into hard assets designed specifically to protect capital during a systemic credit contraction and monetary expansion. Start with acquiring and securely storing your physical gold and silver. This is the emergency fund, the hedge, the ultimate preservation mechanism. Simultaneously, conduct rigorous due diligence on the leading, established royalty and streaming companies. Focus on those with diversified portfolios, low general and administrative costs, and strong management teams with proven track records. These companies are the vehicle for compounding your wealth during the coming monetary restructuring. Do not wait for confirmation from mainstream financial media. They will be the last to acknowledge the collapse of the system that feeds them. Act now, strategically, with the clear understanding that the greatest risks today are not volatility or market fluctuations, but the silent, relentless theft of your savings by government policy. Your retirement security hinges on your willingness to step outside the conventional, failed framework and embrace the enduring truth of sound money. Secure your physical gold, accumulate physical silver, and invest in the de-risked leverage provided by the premier royalty and streaming companies. These three assets, and these three assets alone, are all you need to not just survive, but to truly prosper in the complex economic landscape ahead. The time for deliberation is over. The time for acquisition is now. Ensure your future is built on bedrock, not on the shifting sands of fiat promises.